begin with start that once our chairman is right up to the toes when he is working hard with along with his all teams, it is also my duty to be professionally updated and share my knowledge with all the members, which benefits at large. And with the initiative which chairman sir and supporting committee members takes, that organizing such a events, that is relearn, interacting with different professionals, obviously somewhere or the other it shares knowledge, and sharing of knowledge adds to the subject. So along with that, keeping that those points in mind, I will take the session ahead with your permission, sir. Screen is visible? PPT is visible or?
No, still not.
Not.
Now?
No, not yet.
Now?
Yeah.
Yes, yes.
Yeah. So as the topic says, Relearn series on income tax. Basically, relearn means let us go back, learn, and execute it. As chairman sir also pointed out that at most of the times we are at the execution stage. He rightly pointed out that take a break, just relook at the provisions, because the provisions are so dynamic, compliances has increased. So as to do justice to the subject, we need to relearn the provisions of the taxation, of course, under the different heads of income. So I'll take you forward to the Relearn series of income tax issues with regards to IT return on head income salary. Something is wrong, I think. Just a second. Yeah, sorry for the interruption. Yes. So as I said, that the relearn meaning, let us go back to the basic concepts of salary. Then I have taken forward the taxation aspect of the salary, certain exemptions and deductions which are taken at large by the employees with HRA, certain in the case laws with regards to HRA, which are delivered recently. Then disclosures of salary in return of income, how to disclose salary perquisites, etc. Of course, ESOP is the new trend which the employers has started initiating to retain the employees. Taxation of ESOP, disclosure requirements, specifically insisting on disclosure under FA schedule, is foreign assets, which has been pressed upon by the authorities also. The recent developments with regards to salary and the structure of Form 16. Yeah. So income tax provides a legal framework to impose a tax on a particular income. So before going to tax an income, we should be classifying the income under which head it would be taxed, as each and every head of income has its own modalities to tax a particular income. So basically chapter 4 of Income Tax Act prescribes income of a person under different heads of income. So first heads of income relates to salary, and that charging section 15 provides for taxation of salary. And income earned under the salary holds a great significance, because I think salaried persons are the most honest taxpayers because of the limited tax avenues, tax benefits available to them. Yeah, benefits available to them, and per se, salary basically is a fixed amount, or you can say a payout given to an employee for the work which has been done for a particular time frame. Now, there is a concept called salary because of the employer-employee relationship, master-servant relationship. There is a litigations, whether this is to be taxed, subject matter of litigation, whether this is to be taxed as a salary or as a professional fee. I have cited certain judicial decisions also. However, it depends. There is no thumb rule to it. However, it completely depends upon case to case basis and the facts of the case. First, what is salary? Salary, as I said, that it is a payout given by the employer to an employee for his work being rendered for a time frame. So basic provision needs to be kept in mind so that proper disclosures on the return of income is done, and which ensures also a fair assessment of a return. As I said, section 15 provides for charging section of a salary. It says any salary due from an employer or a former employer, any salary paid or allowed by or on behalf of employer or a former employer, and any arrears paid to the employee. These are the three basic criteria where salary gets covered, and it is taxed under section 15. Please mind well, salary also includes pension. However, I have specifically mentioned that salary excludes family pension. Of course, family pension is a pension given to the family of a deceased by his employer. It is not taxed under the head salary, or it is taxed under the head income from other sources. Certain important points which I would like to highlight, which is of course faced by us also. When salary is paid in advance, it happens many times that salary is paid in advance, and if it is included in the total income of the employee, make sure that whenever it becomes due, it is not again included in the income. Second part, the employer-employee relationship. As I said, there is no thumb rule which defines whether this is an employer or employee relationship. Of course, during a period of time, there are many decisions which has mitigated the controversies. However, certain old judicial decisions I have highlighted, which is one of the decision is Dharangdara Chemicals Works Limited versus State of Maharashtra, where the court prima facie tested the relationship that whether the particular work or the nature of work which has been allotted or provided, and whether the rights to supervise and control that particular work and an employee is vested upon by the work employer. That the court observed, and which it applied uniformly in order to determine whether the employer and employee relationship existed or not. Basically, this decision relates it to workmen who are working with the salt work in Run of Kutch way back. So this is in that context. However, the crux, whether the employer-employee relationship existed or not, was provided for. Another decision which I have highlighted is of Simmons versus Health Laundry, where Fletcher Moulton had cited that there is a very thin line of difference between existence of an employer or employee relationship, or it is not an employer or employer relationship. There is a concept called contract of service and contract for service. As I said, what he mentioned in the decision, I've just cited that in my PPT. In my opinion, I'll just read that. in my opinion, it is possible to lay down. It is not possible to lay down any rule of law distinguishing the one from the other. It is a question of fact to be decided by all the circumstances of the case. The greater the amount of direct control exercised over the person contracting for them, the stronger the ground for holding it to be a contract of service. And similarly, the greater the degree of independence of such control, the greater the probability that the services rendered are of professional nature. As I said, there is no thumb rule that this is employer-employee relationship. For example, we as a professional also render professional services to our clients. There are tender documents or we apply for the tender, wherein these different scopes are mentioned by the clients. We have to perform according to that scope of work. Now, whether we'll amount to contract of service or contract for service. And at the same time, when a chartered accountant qualifies, when a student qualifies as a chartered accountant and he applies for a job, the employer usually executes a contract between him and the employee. So at the first instance, where there are tender documents out where we as a firm apply for that particular professional activity, we are of course given the scope which we need to execute it. However, we are independent as a firm because we have to execute those scope during a particular time frame. There won't be anyone to ask us why this was not done. Of course, we have to meet certain deadlines, certain timelines, but no watch is kept on us. Unlike employer-employee relationship, where he has certain aspects to fulfill, such as attendance criteria, whether he wants to go on leave or not, he has to apply leave to his higher authorities, approve it. Such kind of criteria are not there under tender. Another decision was with regards to CIT versus Govinda Swaminathan, and there it was held that there is no employer and employee relationship between a state government and an advocate general. Advocate general usually appears on behalf of the state government as a professional to represent the state government. So there is no employer-employee relationship between state government and advocate general, though he is paid monthly salary, but the nature of work which he executes it is not controllable by the state government, in the sense that advocate general on his own defends the state government in different litigation matters. Another judicial decisions with relates to Devkinanda Agarwala versus Union of India. The High Court judges and the Supreme Court judges are not employees, and hence no employer. However, ipso facto meaning, am I audible?
Yeah, Chintan, you are perfectly audible.
Yeah. So there is a constant. The judges of the court, High Court and the Apex Court, which is Supreme Court, are bound to function according to certain criteria which are given in Article 125 and 221 of the Constitution. They are given certain guidelines how to function. Hence, they are not related to employer and employee relationship, but a certain guidelines which are prescribed for the judges are bound. They are bound to comply with those functions. And in that particular article 125 and 221 specifically states that the judges, whatever the remuneration or salary which they receive, are to be taxed as a salary, though formally they do not have employer or employee relationship. This was something different, and hence I have cited this decision because there does not exist employer and employee relationship. However, due to certain prescribed rules and article of the Constitution, it is taxed as a salary. Of course, gratuity is a payment made by the employer or a former employer to the employees for the services rendered by him during his tenure, and is taxable under the head salary. Of course, certain gratuities are exempt under section 1010, and of course, gratuity received by the employee of central government, state government, or local authority is fully exempt. And there are certain criteria prescribed under the Payment of Gratuity Act to calculate whether the gratuity is exempt or not. Also, that depends whether your employee is registered with the Payment of Gratuity Act. Most of the employees are registered under the Payment of Gratuity Act. However, in the budget, the ceiling limit of exemption of gratuity was increased from 10 lakhs to 20 lakhs. So if gratuity received by an individual crosses the threshold, the differential is taxed, and up to 20 lakhs, it is completely exempt. This is what we saw salary. Now coming to perquisites. Perquisites is a emolument which is given in cash or in kind by the employer to the employee, which may be in the sort of value of free rent accommodation, value of any concession provided in rental accommodation. Free rent accommodation, of course, becomes in kind, and value of any benefit or free gift being granted to the employee at a very maybe nominal or a concessional rate. Any sum paid by the employer in respect of any obligation the employee. Because ESOP securities, this was recently been taxed by the government. Contribution made by the employer in a recognized provident fund or a superannuation pension scheme of government, to the extent it exceeds 7.5 lakhs. This was taxed 2 years prior. So in Finance Act, I think 2021, it brought in. Of course, family allowance, membership of a club are sort of perquisites. Of course, there are no broad list of the perquisites. However, there are criteria whether these perquisites are taxable or not. Certain I have listed down. Meanwhile, personal accident policy, where premium is paid by the employer, is not a perquisite. Specifically, after the COVID-19 pandemic, many employers have initiated this personal accident policy where the employer specifically is involved in the manufacturing activity. They usually pay premium for their employees to avoid any negative consequences. Another aspect, salary, perquisites, and profit in lieu of salary. Profit in lieu of salary means something which is not in the form of salary, but it adds to the salary. Any compensation due to or received by an assessee from his employer or former employer, or in connection with the termination of his employee or certain modification in terms of his employment. We as a professional usually get joining bonuses when we switch our employment. So the joining bonus which we get from our new employer is prior to our employment, and it is taxed under the head salary, getting covered under profit in lieu of salary. Any cited in point to any amount due or received, whether in lump sum or otherwise, from any person before his joining an employment. As I said, joining bonus received from the new employer when we switch our employee gets taxed, and after cessation of his employment with that particular person. It happens that this bonus is received to the employee in trenches, maybe quarterly, half yearly. Even though it gets credited to the account of the employee. It is taxed under the head salary. These were the basic concepts of the salary. Now coming to taxation part of the salary, because you might be aware about the old regime and the new regime of taxation. Just a highlight of the old tax regime and new tax regime. This is old tax regime. The slab rates are same. It is not being changed. New tax regime under section 115 BAC, where the slab rates are increased and at the same time tax rates are also minimized. However, certain exemptions and deductions are to be foregone. Under the new tax regime, as I said, tax rates are reduced and certain deductions and exemptions set-offs are not permitted. So there is a change in the new tax regime as compared to Finance Act 2020 and as prescribed in the Finance Act 2023. Not much wider change, but I've just cited what is the change. The recent Finance Act 2023 has made a new tax regime as a default regime from AY 2024 onwards, unlike in the current situation. When we file our return of income for AY 23-24, old tax regime is a default regime. Whenever an employer asks you whether you're opting for an old tax regime or a new tax regime, and if no response has been received by them, they usually go to deduct TDS as per the old tax regime, which is the default tax regime. Now from AY 2024 onwards, that is current financial year onwards, new tax regime will be the default tax regime, where the employers, if they do not get any response, needs to deduct TDS as per the new tax regime, because they won't be giving you certain exemptions and deductions. However, there is an option where you can opt out of the new tax regime and choose the old one, if that is beneficial to you. New tax regime was first introduced in Finance Act 2020, where assessee was given an option to choose new tax regime. As I said, unlike the current situation, which offers reduced rate of tax, however, certain terms and conditions are. Certain exemptions and deductions which are not allowed under the new tax regime. Leave travel allowance. Broadly, I have cited certain deductions and exemptions. The HRA, the main factor, is not allowed. Certain specific special allowance as prescribed under section 1014. Standard deduction, mind well, for current assessment year, from that is 24-25 onwards, 50,000 standard deduction is allowed under the new tax regime. Or when you file return of income for AY 23-24 under the new tax regime, standard deduction of 50,000 is not allowed. It is allowed only from AY 24-25. That is the major change between the new tax regime, which was prescribed under Finance Act 2020 and Finance Act 2023. Certain entertainment allowances received from government, daily allowance and Chapter 6A deductions, unless otherwise specifically prescribed. Now, we just need to keep in mind, whenever certain benefits passed on by the IT authorities, there are always terms and conditions being involved. One of the terms and conditions which we tend to forget is compliance with regard to filing of certain forms to avail the subsidized rate of tax. Option to be exercised on or before filing return of income under section 139(1) of the Act. Of course, no exemptions and deductions are allowed. Inform your deductor, that is the employer, about your intention to opt for new tax regime. If you have informed your employer well at the beginning of the financial year, you still have an option to switch when you file your return of income. If old scheme is beneficial, you can opt for that. This is very important. Please ensure to file Form 10IE. 10IE, if form is filed, you can choose the new tax regime for the current, for the return of income being filed for AY 23-24. However, if new tax regime is already opted, make sure that you mention the acknowledgement number and date of filing of Form 10IE in the current year's return of income, which you will be filing maybe in this week. There's a big point coming up whether filing of form to choose or exercise an option is mandatory or it is directory. Suppose, for example, if you have not filed a particular form to exercise a particular, to exercise a subsidized rate of tax, whether that particular rate of tax which you have opted will be accepted by the income tax department. One can put it in a way whether the original return being filed by the taxpayer is under the old regime, and while revising a return, he can opt new tax regime or not. So, per se, Income Tax Act does not specifically provide for a change of tax regime option while filing income tax return, nor does it prohibit us to choose the or change the regime while filing revised return. Of course, we suo moto do not revise return unless and until there is certain lacuna being found. We can choose, however, there are two criteria to this point. One, if the ITR is filed on or before the expiry of the due date, that is on or before the time limit prescribed under section 139(1). Suppose if a taxpayer having a business income and has filed his return of income under the old tax regime, of course before the due date, meaning before 31st of July, and he found certain income not being disclosed and he wishes to revise his return. However, when he revises his return, he just thinks of whether he can opt for the new tax regime or not. The taxpayer can opt for the new tax regime. However, it is litigative. If there is a substantial difference, you can litigate it. Per se, I have cited one decision of Bholanath Precision Engineering Private Limited versus CIT, which is a recent Mumbai tribunal decision where benefit of lower tax rate was denied to the assessee because he did not file Form 10IC to avail option under section 115BAA, which prescribes reduced rate of tax, that is 22% instead of 30%. The assessee did not file that particular return, which is mandatorily prescribed by the Act. So, as I said, that it is a subject matter of litigation. If there is a substantial difference in your taxable income and the tax, you can just think. However, it is not an advisable option. Better to comply with the conditions prescribed. File your Form 10IE. Make sure that you mention the filing acknowledgement and the date also in your return of income, and keep a copy of the same in your record. Vice versa, if a new tax regime has been opted by a taxpayer, however, he wants to opt for old tax regime. In such a scenario, it is not possible because you must have already filed Form 10IE, which by default will take you under section 115BAC, that is a new tax regime. So this was just to highlight the modalities of change of tax regime. However, it is not advisable to change. You just, before filing of return, check under which regime you are benefited the most and opt for the regime rather than changing at a later date. There is an income tax tool also available on the income tax website which helps you to determine whether a particular income earned by you is beneficial under the new tax regime or the old tax regime. Of course, if the return is belatedly filed, you cannot opt for a new tax regime. If you wish to, will be by default taken under the old tax regime. And one may even point it out whether change in regime, that is new or old, whether there is specific penalty being levied. So under the act, there is no specific penalty mentioned for change of tax regime at a later date. However, the avenues with the department is always open, that they may take you to at discretion and you may have to litigate it. Of course, revision of tax limit invites additional tax and interest under section 234A, 234B and 234C. And if returns are belatedly filed, set off and carry forward provisions are also affected. These things needs to be kept in mind. I hope old and new tax regime, all the assessees are aware of, and once you will be filing your return of income in this week, make sure that you check which regime is more beneficial for a particular taxpayer rather than opting for it at a later stage. Of course, when you opt for a new tax regime, make sure you file Form 10IE. Yeah, certain major point, salary from more than one employer. This happens usually when we change the employment period, or we work for a certain individual for certain days and another employer for a certain period of time. Usually I have seen when there is a change of employment, the new employer again calculates the TDS portion by calculating all the basic exemptions, deductions, wherein the employee then at a later stage while filing return of income ends up paying tax. And also another aspect to it, if by clubbing the income from both the employer crosses the threshold limit of 550 lakhs, it may invites additional surcharge, which both the employers might have not considered it, because say if particular employee has a salary from employer one to the extent of 30 lakhs, and when he changes his employment, the new employer offers him a 35 lakhs. So individually from each employer it is below 50 lakhs. However, when we file his return of income, the threshold of 50 lakhs will cross. So that invites surcharge, which neither of the employer might have taken into consideration. So this aspect we usually face when we file return of income who change their employment, where we advise them to inform employer specifically in writing that what he intends to, and when there is a change in employment, the TDS aspect needs to be taken care. Yes, certain points which as an employer he needs to keep in mind while filing statement of return in Form 24Q. The employer should quote the gross amount in his statement of return Form 24Q, including those transactions which are exempt under Section 10, and also the deductions which are applicable to a particular employee under Chapter 6A. If there are particular reasons for non-deduction or mention lower deduction certificates or higher deductions, that is non-furnishing of PAN, the employer is bound to report that. PAN of landlord, yes. there is a CBDT circular which prescribes if a particular employee pays rental income more than 1 lakh in a year, he is bound to provide PAN of a landlord to the employer, so that he mentions that particular PAN of a landlord in this particular statement of return. The implication of that, I'll come to it at a later stage when we take up HRA slide. PAN of a lender should be mandatory when we take interest deduction in case of our housing loans. PAN is to be mentioned to the employer. As long as our documentation part is proper and furnished to the employer, it is a good practice that we should implement, and which allows as a individual to report his incomes in his return of income properly, and also he does not face problems in assessment. Yes, perquisites. As I said, I'll be covering how to report perquisites in return of income, where there is specifically mentioned under section 17(2), which prescribes reporting of perquisites. The person responsible for paying income which is chargeable under the head salary shall be required to provide complete details of perquisites, because your employer provides you form 12BA, which is in addition to form 16, which prescribes various perquisites given to employee. Make sure that you in your record hold form 12BA. If not, please take it from your employer, which prescribes various perquisites given to a employee, which is to be taxed under the head salary. Coming to HRA exemption, HRA is basically special allowance specifically granted to an assessee by his employer to meet certain rental expenditure incurred by him for residential accommodation. It is to be noted that expenditure actually incurred on payment of rent in respect of residential accommodation occupied by the assessee or taxpayer subject to limits qualify for the exemption. The rent should be actually paid by the taxpayer, and an employee has to submit details of house rent allowance to his employer in form 12BB along with rent paid receipts. As I said, PAN of the landlord shall be mandatorily furnished where the rental income rental expense exceeds rupees 1 lakh in a year. Rent paid receipt is a very crucial document. As I said, that salaried person has limited tax avenues and limited tax deductions, and whatever deductions which are available for a taxpayer needs to be availed by him legitimately. He need to have rent paid receipt which is signed by the landlord or stamped by the landlord. Complete details in that particular, make sure that complete details is mentioned in that rent receipts, like rental payments for which period, name of the landlord, PAN, etc. needs to be there in that particular receipt. And providing a copy of rental agreement or lease deed can further substantiate your claim of allowance. These both aspects were important in the coming case law, which I am going to take up, which might be aware also. This is the calculation of HRA in metro cities and in other cities. HRA allowance actual in metro cities, it is actual allowance received, list of the following for HR allowance actually received, rent paid in excess of 10% of salary or 50% of salary, whichever is lower is allowed as a HRA allowance. And in other cities, first two conditions are the same. Instead of 50% of salary, it is 40% of salary. However, when you calculate component salary, because it includes dearness allowance, but it excludes perquisites and other specific allowance. So make sure that you calculate HRA, ask for certain documentations from the taxpayer. Just because it is appearing in Form 16, don't just execute and claim that allowance. Ask the taxpayer whether actually he is being claiming HRA allowance legitimately. One of the two major decisions given by, both the decisions are interestingly given by ITAT Delhi. One in the case of Aman Kumar Jain, I've cited this decision where husband was paying rent to his wife who owned a residential property, and husband was claiming the HRA deduction from his salary income. The said residential property was purchased by his wife procuring loans from banks, wherein she repaid the loans and also the interest component. Of course, when wife had offered the particular rental payments received by her from his husband from under the head income from house property, and apart from rental income, she also had different other income which was taxed under different heads of income. One of them was business income and other was income from other sources. This was specifically mentioned to substantiate the fact that the rental income was not only the income earned by the wife, she was independent enough to earn business income and certain interest income which was taxed under income from other sources. Now, the viewpoint of the authorities, ITO and CIT appeals, was basically framing and keeping in mind the relationship of husband and wife and not independently seeing the transaction. So they denied that it is mere transaction and not a commercial one. And keeping in mind that wife was earning a nominal income. Had that been the case, the wife wouldn't have obtained loans from banks. So where she was financially independent, where she repaid the loan, paid all the installments to the bank. After all, based on the facts and the documents, where all the documents such as rent paid receipts were provided to the authorities, and the decision was in favor of the assessee. Another similar decision was with regards to Abhay Kumar Mittal, again given by Tribunal Delhi, and the, as I said, issue before the bench was whether the rent paid to wife is allowed as a deduction from HRA and is subject to clubbing provisions in the hands of husband. Because the Act does not prohibit claiming HRA exemption on rent being paid to one's spouse. It prescribes that rent should have been paid. Here, the wife was a qualified professional and was, in both the cases, wives were filing their return of income regularly. And wife had, for acquiring a property, wife obtained loan from husband, which she later on repaid from the investment proceeds, which were mutual funds, fixed deposits, etc. The rent receipts, as I said, in both the cases, rent receipts were offered for tax under the head income from house property by the wife. So it was not a case of tax evasion, but they just looked from the point of view of that this is a mere transaction between a husband and wife. So I've just cited down key takeaways from both the decision is that the Income Tax Act does not debar claiming HRA exemption on rent being paid to one spouse. Of course, the rent component has to be commercial transaction. It should not be that it is nominal amount, which which can be determined keeping in mind the relationship. In the eyes of the law, both husband and wife are different persons. Both are independent person. The contention that the transaction between husband and wife are not commercial and a meager arrangement does not hold merit unless and until it is proved. In both the cases, it was legitimately proved that the claim of exemption was valid. Also a fact that scale and level of income, where it decides the fate whether a capital asset can be bought by the assessee. One of the recent case law also, I do not recollect the citation, but it was there in the, I read somewhere, which said that insurance premium being paid by the assessee was way high than his taxable income. Of course, considering other aspects also, the crux of the case was that whether the premium being paid by the assessee, that he can afford to pay that particular premium. Because ultimately the assessee challenged that particular addition being made by the IT authorities, income tax department, which ultimately gave a favorable decision in favor of assessee. It is not necessary that all receipts are taxable. An assessee can have a capital receipt. He may have a capital built up during his tenure. So it does not determine whether the level of income being earned by a particular taxpayer, whether he can purchase a particular capital asset or can afford certain expenses being borne by him. HRA granted to an employee who is residing in a house owned by him does not qualify for exemption. As I said, just don't take allowance with just because it is appearing in Form 16. Ask the taxpayer whether he actually is residing in a rented premises. If not, as a precautionary measure, just inform him about the consequences which he may face going ahead. If he does not stay, if he does stay in a residential premises owned by him and claiming HRA exemption. Now coming to disclosure of salary components in return of income. Salary, as I said, gross salary is to be disclosed, and then the breakup of each component. Salary as per section 17(1), which we saw, perquisites, various types of perquisites which is prescribed in Form 12BA. If not, please ask your employer to give you Form 12BA so that you can show separately. And profit in lieu of salary is to be shown separately. Income from retirement benefit account maintained in the notified country, because there are certain criteria to it, attached to it. As I said, you mention the gross salary in return of income and then claim the exemptions and deductions. At part 2, at point number 2, you can see less allowances to the extent exempt under section 10, which you need to select which type of allowance are exempt under section 10. And then the net salary is arrived before certain standard deductions which is allowed under section 16, which is standard deduction under section 16, 50,000. Of course, entertainment allowance and profession tax. Of course, these deductions are not available if you opt for new tax regime. This aspect is also very important. Usually, when we file return of income of a director, where director's remuneration, of course, is taxed as a salary. However, we tend to forget disclosure of his directorship. So to cover that aspect, I've highlighted this point that disclosure of directorship in return of income is important. where you need to mention whether he is a director at any point of time during the previous year. Even when he ceases to be a director during a particular year, it is you need to mention his tenure in this particular disclosure, whether you were a director in a company at any time during the previous year. Of course, when you select yes, it also gives you an option to mention the DIN number of a director. You need to mention the name of the companies in which he is director, type of the company, whether it is domestic company or a foreign company, PAN of a company. Don't mention PAN of the director over here, that is the taxpayer of the year. Usually when we are in hurry, we tend to forget and mention by mistake mention the PAN of the assessee instead of PAN of the director, whether such shares are listed or unlisted, and the DIN number. Yes, this is also an important aspect where certain unlisted equity shares are held during the previous year by a taxpayer. Usually when we exercise our option of ESOP, we tend to forget reporting in this particular schedule. So whenever a taxpayer or a assessee you come across where he has exercised and he holds ESOP, mention those details over here, whether he holds any unlisted, of course, if that particular equity shares are unlisted. Whether you have held, and the schedule reads as whether you have held unlisted equity shares at any point of time during the previous year. If yes, then mention details such as name of the company, type of the company, the PAN of the company, the opening balance. If you have acquired, then obviously there won't be any opening balance, and you need to mention the details in shares acquired during the year and shares transferred during the year and the closing balance. The details such as number of shares, cost, the price at which you have acquired needs to be mentioned. Even if you have transferred the shares, it happens when employment period is over or you have transferred the ESOPs to other person, you need to mention this schedule where you will be reporting the opening balance of the shares held by you and transferred during the year. Thereby, there won't be any closing balance. Please keep in mind to report this in case of ESOPs. Yes, corresponding disclosure under TDS. Tax deducted by the employer, which we usually mention under the TDS schedule. Please keep in mind whatever figure we mentioned at column 4, that is income chargeable under the head salary, should correspond to the income of schedule, should correspond to the income disclosed under schedule S, that is salary. Sometimes it happens that there is a mismatch between both the figures, and if there is assessment, it might create a problem. So do ensure that the income which is reported in column 4 matches with the schedule S, that is income chargeable under the head salary. Mention the TAN of the employer, name of the employer, and if there is change in employment, you need to mention both the details, of the employer in schedule, tax deducted at source. I have mentioned specifically income chargeable under salaries, that is column 4, should match with the income chargeable under the head salary, which is shown in schedule S. Of course, over here, just keep in mind when there is change of employment, we tend to, hurriedly, we tend to mention TAN of another employer sometimes. So keep in mind to mention the correct TAN of respective corresponding employer only. Just to brief on the ESOP aspect, the broad framework of ESOP, which is one of the trending I would say that trending aspect where the startups and all offer ESOPs to retain the employees. So how the offer has been made and the taxation aspect of ESOP. Basically, ESOPs are taxed twice. One, at the time when the employee exercises the option, and second, when he sells the shares. Because when he exercises the option, it is taxed under the head salary, and when he sells the shares, it is taxed under the head capital gains. So just a broad framework how ESOP works. Employer makes an offer of ESOPs at a predetermined price to the employees. Employee, not necessary that he has to exercise, employee can exercise an offer as per the terms of ESOP offered by the employer and can execute it at a exercise price may either be, of course, when the employee exercises an offer, the exercise price, which is predetermined and given by the employer, has to be less than the market price of that share. As I said, taxation of ESOP are taxed at two stages. First, when the employee exercises the option, exercises the ESOP. We'll come to how it is to be determined. And secondly, tax when such ESOPs are sold, which results in capital gains. Just highlighted that the difference of price between the exercise price and the market price is taxed as a perquisite and ultimately taxed under the in the hands of employee, and secondly under the capital gains. As I said, ESOP is a popular long-term incentive initiated by the employees, specifically by the startups, which is basically to attract and retain and provide rewards for the employees. So they give an opportunity to the employer to be part of a company and become a shareholder, and ESOP is of course a variant as a startup. It is usually granted to, it may happen that it is usually granted to certain category of employees and not all employees, maybe top management or top category employees, where they exercise an option at a predetermined price, which we saw in the framework. Coming to taxation of ESOPs, considering the proposal of ESOP, rather three stages, basically broadly three stages, is grant, vesting period, and exercise period. It is most important to know before exercising the ESOP. It is important to know whether and at what point of time taxes are levied. So, as per Income Tax Act 1961, the tax implications gets triggered at two stages. One, at the time of exercise of the option, as I said, under the head salary as a perquisite, and second, at the time of sale of shares under the head capital gains. First part of taxation, that is at the time of exercise of the option, it is the first taxable event in the hands of the employees and is taxed as a perquisite. How to determine the value of perquisite? Value of perquisite is determined as difference between the fair market value on the date of exercise as reduced by the exercise price actually paid for into the multiplied by the shares being given to the employee. Of course, the exercise price is lower than the fair market value, so that becomes value of your perquisite, which is on which your employer will be deducting tax at source. Because as I said, he is bound to report that in his statement of return, that is form 24Q, on the said perquisite, the employer is required to deduct tax at source, and the same gets reflected in our form 16, annexure form 12BA. In that particular form, there is a line item called stock option where it appears the employer mentions that a particular employee has executed or has exercised the ESOP, which is taxed as a perquisite. How to determine the fair market value? Of course, in case of listed shares, fair market value shall be the average of the opening price and the closing price of the share on a recognized stock exchange on the date of the exercise of the option. In case of unlisted shares, there is a challenge with regards to determining the fair market value. Based as per the rules, fair market value of shares shall be determined by a merchant banker on a specified date, which is the exercised date. So hope I'm clear with the first aspect of taxation of ESOP, which is at the time of exercise of the option. Certain eligible startups do not have to pay tax in the year of exercise of option, but has to retain it and defer their tax payments at a later stage. So later stage being earliest of the following: expiry of 5 years from the year of ESOP allocation, date of sale by the employee or transfer by the employer, or date of termination of employment. Now, this eligible startups is specifically defined where they are incorporated between 1st of April 2016 to 1st of April 2021, and where their turnover is within the prescribed limit of 25 crores, and make sure that those startups are registered with the government and holds a certificate of eligible business from Inter-Ministerial Board, IMT certificate. Only those startups are allowed to defer their tax. If they are not recognized as an eligible startup, of course, their first trigger point at the of taxation would be the exercising the option by the employee, and they have to deduct the tax. Second point of taxation comes at the time of sale of shares. At the time of sale of shares, it is taxed under, as I said, it is taxed under the head capital gains and capital gain taxes attracted. Capital gain will be, because capital gain will be computed on the difference between the sale price and the FMV of the shares on the date of exercise of the option. Meanwhile, it is the FMV of the shares as on the date of exercise and not the price at which exercise of the option was done, because at the first instance, it was already taxed. Difference between the FMV and the date of exercise of the option. Capital gains is further classified as a short term and a long term. Of course, if unlisted, in case of unlisted shares, if it is held for more than 24 months, it qualifies as a long term. And in case of listed shares, if held for more than 12 months, it qualifies as a long term capital asset. I've also mentioned the taxation aspect listed on a recognized stock exchange. Long-term capital gains exceeding rupees 1 lakh are taxed at 10% without indexation benefit, because in case of listed shares, there is no indexation benefit. Short-term capital gains are liable for taxation at 15% listed. And in case if it is not listed on a recognized unlisted shares or are not listed on a recognized stock exchange, if it is a long-term asset that is over, if you have hold on for more than 24 months, it is taxable at 20% with indexation benefit. And in case of short term, it is taxed as per the slab rates of the individual. It is meanwhile, it is not taxed at 15%. ESOPs, yeah, it may happen that a particular taxpayer has an ESOP of a foreign company. He might be well working with a Indian company which happens to be a subsidiary of a foreign company, and foreign company has allotted ESOPs of a parent company. So tax treatment is not different from the tax treatment of ESOPs of an Indian entities. Of course, from the point of view of that it is not listed on a recognized stock exchange uh, within our country, it may happen that it is listed in their respective country. So it is of course taxed at in his respective country. However, in case it is taxed, then DTAA benefit can be availed by the taxpayer. I've taken this in the next slide also. Yeah. So ESOPs, we just came across a case where the ESOPs were held by a particular taxpayer of a parent company, wherein he on retirement it was compulsorily to be terminated. So on retirement, of course, it is from income tax perspective, it is not listed on a recognized stock exchange, and it is to be termed as a capital asset. And once if it is a capital asset, it is taxed as a capital gain tax. Of course, then depending upon his holding criteria, whether he has held for more than 24 months, accordingly it is taxed. So ultimately it was taxed at 20% and indexation benefit was given. However, do remember ESOPs are given in different exercising options. So those being exercised by him during the last 12 months period, or say maybe 24 months period, is to be considered as short term. So you need to bifurcate as short term and long term and then tax it accordingly. Yes, this is very important. Disclosure of ESOPs held by a taxpayer. Details of shares held in unlisted company needs to be reported by employee. Make sure that you disclose the ESOPs held by a taxpayer in the schedule unlisted equity shares, which we saw in our earlier slide. And if it is ESOP of a foreign company, make sure that the shares of foreign entity allotted under the ESOP scheme is reported or is also reported in unlisted equity shares held by a assessee. However, if it is a foreign asset, additional requirements gets triggered, that is Schedule FA. Shares allotted by a foreign company to an employee, as I said, qualifies as a foreign asset, and the requirements of disclosure gets triggered. You need to mention that particular aspect in Schedule Foreign Assets. Please note not to forget this, because it may happen that hurriedly when we in a hurry when we file our return of income, this aspect is forgotten. As I said, that we are not here to only execute the things. We are here to analyze, report correctly so that the taxpayer does not face any problem going ahead and his return is properly assessed. And of course, if the employee's total income exceeds rupees 50 lakhs, he has to disclose Schedule AL, which is asset liability, where he reports certain assets held by him and liability aspect also. In Schedule Asset, there is a column called equity shares. You need to report there where the salary of a particular income or a particular employee exceeds rupees 50 lakhs. You need to report there also. So keep in mind these two schedules. Schedule FA in case of foreign ESOPs held by a particular taxpayer, and Schedule AL in case the total income of the employee crosses rupees 50 lakhs. Yeah. So, coming to recent developments in AIS, is AIS fully reliable for ITR filings? Can we rely on AIS? It may happen that in the coming week, when you file your return of income, certain details are not available, and you may take base as AIS, or you can say as tax information system, that is TIS, whether those particular documents can be taken as a base to file return of income. Of course, AIS is a document which shows and reflects financial transactions executed by a particular taxpayer during a financial year. And the information which reflects in AIS are based on the filings being done by a entities or a person as prescribed under the Income Tax Act. It may happen that the information reflected in AIS does not match with the information of a taxpayer which he holds, say Form 16. It should match, but at times we have observed that the income being reported in AIS and the income being reported in 26 AS are different. So you need to provide feedback on AIS portal that certain figures are not matching, so that you don't face any action going ahead. Of course, there are certain aspects, certain incomes which are not reflected in AIS. As I said, you cannot take AIS as a base to file, because it is a supporting document to file your return of income. As I said, interest income from RBI floating rate bonds, because it is taxable, but they are not reflected in AIS. PPF interest, PPF is a aspect which we often see in salaried taxpayers, where they claim ATC deductions and earn interest. It is better to, of course, interest on PPF is not taxable. It is to be reported under the exempt income category in return of income. As I said, the information being reflected on AIS portal is based on the filings being done by the certain persons prescribed under the Income Tax Act. It may happen that incorrect reporting of interest income is done by the person, or of course, banks usually, when they file their return of income, when they file the statement of financial SFT returns, they tend to report sometimes wrong interest income, which ultimately gets reflected in our AIS. So we need to provide feedback if there is a mismatch of interest. And it is always a healthy practice to report exempt income in return of income. One of the major and popular transaction is PPF interest. Yeah. Details, as I said earlier, why we need to produce PAN number of a landlord when we pay rental payments of over and above 1 lakh. I'll just give you an example that, say, a particular employee pays a rental payments of over and above 1 lakh. Now he or she is bound to give PAN number to the employer. Employer then, in his statement of return, it is from 24Q, mentions the PAN of that particular landlord. And once that PAN number is mentioned by the employer in his statement of return, that is form 24Q, that particular transaction also gets reflected in the landlord's AIS. So the authorities also come to know that the landlord has a rental income. Connection of producing PAN to the employer is understood. I'll repeat it again. It is mandatory. So to mention PAN of a landlord, if rental payments exceeds 1 lakh, please give the PAN of a landlord. If landlord does not have a PAN, he has to give a declaration, obtain a declaration from landlord and give it to your employer that he does not hold a PAN. And while filing return of income, make sure this e-verification aspect, because we sometimes tend to forget when we file so many returns of income, we tend to forget to e-verify return. So timeline is 30 days. If we don't e-verify a return, it is prescribed the day when you e-verify your return is the date of filing of return. It may take you to the aspect that your return is belatedly filed, it is not filed on time. So it is a healthy practice that when you file return of income or a taxpayer files his return of income, he e-verifies the return at that point of time only. Salaried, there was a news in Economic Times couple of days back that salaried individuals are under IT scanner, that certain notices are being sent to individual taxpayers asking them to produce documentary proof for claim of exemptions. So as I said, the major aspect being claim of house rent allowance. So revisit your transaction, just have a look whether HRA is actually being claimed by you. And as I said, because salaried persons are the most honest taxpayers, because from their source itself, the tax gets deducted. So, and with limited tax benefits, they must be contributing to the tax collections. And once the documentation aspects are clear and as per the requirements of the law, you need not worry about the notices being sent to you. If, as I said, if disclosure requirements are correctly made and legitimate tax deductions and exemptions are availed, you need not worry about the notices. Niglam is just a cross check being made by the authorities. There are instances where they found that certain unhealthy practices were being observed by them. So make sure in case of salaried taxpayers, you hold proper ATC deductions, documentary evidence. It might be LIC premium or PPF or investment in ELSS, mediclaims, etc., etc. Specifically with regards to HRA. Now coming to structure of Form 16. Structure of Form 16 is important from the point of view of reporting of income. Say, I have observed and I have seen that during the last phase of return of filing of individual taxpayers, they tend to give hassle, they tend to give Form 16 of previous year. So we, as a consultant to them, you usually don't observe that whether the particular Form 16 is correct for a particular assessment year. So that particular aspect is also very important. I have highlighted certain tables. We can discuss that name and address of the employer should be correct as per the PAN of the employer. PAN of the deductor should be correct. TAN of the deductor should be correct, because this only happens based on his employer's filing of return in Form 24Q. Name and address of the employee is correct. PAN of the employee is correct. There are instances that the name is correct, however, the PAN is not correct. So those aspects needs to be checked, and it may happen that if PAN is not correct, Please inform your employer to correct the PAN. He will revise his statement of return in Form 24Q and give you the correct Form 16. Check the assessment year for which it has been issued and the period of the employment. Over here, I'd like to highlight that if there is change in employment period, say for first half year, we have worked with employer 1, and for the second half year, you have worked with employer 2. The period from and to changes. Usually it is 1st of April 2022 to 31st of March for the year ending, say 1st April 2022 to 31st of March 2023. However, when this change of employment, it has to break when employee ceases his employment period. Say up to 30th of September, he was working with employer 1, and from say October onwards, he was working with employer 2. So the period over here to be mentioned is 1st of April 2022 to 30th of September 2022. And the Form 16 from employer 2 should be from say the joining date, if we say 10th of October or whatever the employee selects, to 31st of March 2023. These are the basic aspects of Form 16. Of course, as I discussed earlier also, you may have faced a situation where there is change of employment and usually the employee does not inform the employer about the basic exemption being already taken by the employer 1. So specifically mention in writing and advise your taxpayer that if the total income is likely to exceed 50 lakhs, surcharge aspect may get triggered. So better to pay advance tax to that extent. Because if it is not paid and there is a surcharge liability, it also affects interest aspects under 234A, B, and C. Just a sec. Yes. Coming to second aspect of Form 16, the summary of output, summary of amount paid, credited, and tax deducted at source thereon. First, the employer is supposed to file Form 24Q for salary payments quarterly. TDS returns are filed quarterly. So all the amounts being paid to the employee are reflected in different quarters of a particular financial year. Make sure the amount which is reflected in Form 16 also gets reflected in AIS. It should not happen that both the amounts are different. If both the amounts are different, either ask the employer to change Form 16 by filing his revised return, or you may give your feedback on AIS transaction. This particular schedule prescribes the amount being paid credited to the employee and amount of tax being deducted and amount of tax being deposited and remitted to the government's treasury. Details of tax deducted and deposited in said government's account through a challan. SIN number. SIN number gets reflected based on, as I said, based on the filings done by the employer. Tax deposited in respect of the deductee, BSR code, the date on which tax has been deducted, deposited, the challan serial number, and the status of matching with the old tax. Please ensure, as I have already cited, that please ensure that details are disclosed in 26 AS of employee, which also corresponds to the details as reflected in Form 16. We have seen, of course, technology has its downsides also, that certain transactions are not fetched properly and correctly. We have come across instances where transactions in Form 16, in Form 26 AS, and in AIS are totally different. So 3 figures are available for a same transaction. So identify what is correct and then file your return of income. Take necessary actions which needs to be taken to correct the transaction either in Form 16 or in AIS. So these were the broad aspects of salaried head of income. So if we can discuss certain points to make it interactive, or if we have any doubts from the participants, we can take up line wise. I'll just open the chat box. I'll take the queries as mentioned in the chat box one by one.
Yeah. Please. You want me to read or Chintan?
No, that's okay. That's okay. I'll go through it and read. This is a query. First point. First query: a client has a refund, but bank account showing validation in progress since last 18 days. Raised the grievance. It says solved, even though status is still showing validation in progress. As per ITR 1, need to one validated bank account. Client has no other bank account. Just see to it that your grievance has been properly filed, because what the IT department have interpreted and what you must have mentioned in the grievance might be different. What I would suggest is just delete the bank and mention the details again, and then check whether it gets validated. Of course, bank account has to be validated to get refund of tax. Bank account needs to be validated, only then it is credited to the bank account. How to provide for interest earned on PF contribution over 2.5 lakhs, which is now taxable, is now taxable when the same has not been updated in the passbook provided online.
I think this is more on fact. If the
Yeah,
book is not
because-
available, maybe you'll have to
See,
calculate
you-
the.
Yeah, because here you have earned interest income. Just because it has not been updated in a passbook is more of a documentary aspect. So we can skip that, or else we can also, of course, this PF went change where it was taxed. Interest income also is taxed and has to be offered for tax. Just because it is not being reflected under passbook does not, give you a leeway that you do not offer for tax. What if house
And
is
more so we know the percentage also. No? See, Chintan, we can calculate as per the prescribed percentage.
yeah
And
we
arrive at
can yes we can arrive at there is a prescribed methodology to arrive at interest income. So based on that we can. The third question: what if the house is co-owned, that is to say 50% owned by husband, 50% owned by wife? Can husband pay rent pertaining to 50% of wife's share to wife? In such a case, can HRA be claimed? If yes, what challenges could arise because of the same? See, here you need to figure it out, because at the same time, when you pay rent, it is obviously getting taxed in the hands of wife. So it should not happen that where at one hand you save tax, and at the other hand you need to pay tax. So that tax aspect you need to calculate, the benefit aspect you need to calculate, whether by paying rent to wife is beneficial or not. So that aspect you have just missed in this. So just take care. Please share how to avail DTAA benefit for ESOP. Yeah. So usually ESOP, when it has been allotted by a foreign entity, it is usually taxed in the country in which that particular ESOPs are allotted. So say, for example, if that particular ESOPs belongs to USA, so obviously the tax aspect has been calculated over there, and the ESOP taxation is not different for foreign assets. It is the criteria for taxation is the same. Only DTAA aspect gets triggered when you hold foreign assets, foreign ESOPs. When, of course, when you become a resident individual, global income is taxed. So if it is taxed over here, you have to take DTAA benefit by taking a tax credit of tax being paid in overseas country. Schedule AL will include all assets of assessee other than FA also. Will it include saving bank balance also? Yeah, so schedule AL, at the top of the AL asset liability part, it specifically states that the assets and liability which are specifically mentioned in the return of income is not to be disclosed over here again. So see, from the fact that certain figures, certain, say, as you pointed out, bank balance. Now, you may have different bank balances with different banks. So we club the bank balances and report in our return of income. So better to show all the bank balances, all the bank names which you held during the previous year, and report it under Schedule AL. Of course, I understand that the total figure has been reported, but to give a more clarity on the aspect, report each bank account being held by you and each bank balances at the year end. Of course, over here, I just missed out DTAA benefit of for ESOP gets triggered. This in case of foreign ESOPs held, it is taxed under the head capital gains. So accordingly, you need to avail DTAA benefit. What happens if there is no DTAA for any ESOP? So obviously, India has this is a specific aspect. And, India has more than 100 DTAA with different countries, so needs to be identified. And as I said, this ESOP, foreign ESOPs are taxed only in the country in which it has been allotted. There are very rare chances that it has been taxed in India as well. But mind well, both a single transaction cannot be taxed twice. If it is taxed over there, it does not get taxed in India. While switching job, if leave encashment is received, what will be its treatment? Will it be considered as leave encashment received during the service and taxable, or exemption available under section? I'm not able to under section 10. Under section 1010 AA, it becomes taxable. Ketan bhai, I think we'll be taking up each and every
Yeah. Time. We have enough time. We can
have
take up
time,
the
huh?
questions.
Okay,
And
okay.
I agree with Chintan with you. It is very clear. It is taxable because
Correct.
it's not on there. Actually, my mobile had some problems, so I have logged in from other mobile.
Not a problem. I am taking up each and every query at a time. So
Perfect. Perfect.
another,
Take as per your time. No problem.
yeah. Can HRA benefit be
Chintan,
claimed?
Chintan, only on
Yeah,
that HRA 50%, actually my mobile went off at that time only. On that, somebody has asked that my wife is a 50% co-owner and I want to pay the rent.
correct.
So actually, the cases which are coming up of, HRA being paid, and you initially discussed, if
Correct.
you
Husband and
recollect,
correct.
recollect that, of course, within four corners of law, I'm having rent agreement, I'm having being offered at those other returns also. But this query was quite peculiar, that, I am also a 50% owner and 50% owner is wife. So
Correct.
whatever market value is there, 50% of that I'm making a rent and paying it to wife. And then I
Correct.
can claim as a HRA. See, the SSC must be claiming the interest
Correct.
benefit also if the home loans are taken. So
Correct.
both the things are not possible according to me, in my personal opinion, that one
Yeah.
place you show that you are also claiming interest benefit and those benefit of
Yeah,
repayment.
correct, Ketan bhai. As you rightly said, because if there is a loan aspect also coming into picture, we also need to figure it out whether the installments and interest are being paid by both of them. It should not
Okay.
happen that the completely interest aspect is being paid by the husband.
And I have
So,
seen, where you are
and
trying to do both, so they are picking up for the scrutiny.
taking up for the
See,
scrutiny. So
it has
once,
happened in some cases.
correct. So the law says once you are the owner of a property, you cannot claim HRA. It never says part of the property or you should be the owner of the property. So if once you are the owner of the property, you cannot claim HRA.
Perfect. Please proceed.
Can HRA benefit be claimed while filing the return if the same is not given by the employer since the document were not submitted? Yes, you can claim HRA benefit. However, there might be intimation. There is possibility that you might get intimation because corresponding transaction will not get reflected. And with CPC Bangalore, they have certain checkpoints where they cross-check with the Form 16 and which is basically based on the filings of the employer. However, when you claim HRA, just see the aspects whether rent has been paid regularly and just not to claim a benefit for lower tax deductions. You can claim HRA benefit if it is not reflecting in Form 16. However, it is also advisable that you inform your employer about the same that you are being claiming this HRA benefit. Can we not claim HRA exemption in case where rent expense is more than 1 lakh per annum and the employee has missed submitting rent receipts to the company? I think this is the same question that which was the previous one, where you can claim HRA where you have paid rent receipts, you have paid rent and you have forgotten to give the receipts to the company. How to show recovery of retention bonus by the employer in ITR. Form 16 shows gross salary. Yes, so usually an annexure is attached to Form 16 where they give breakup of basic salary, dearness allowance, HRA, etc., etc. In that, there is a aspect where this aspect gets covered. Retention bonus, you can show this in your return of income under the head bonus. Now, bonus under the Income Tax Act includes retention bonus. It also includes joining bonus. So there is no specific head such as retention bonus in return of income. You have to disclose the retention bonus received under the head bonus, dearness allowances, etc. being received by the assessee. Make sure you have the annexure attached to the form 16 where employer gives the breakup that this is the retention bonus being received by you. Whether mediclaim provided to employee is taxable perquisite or exempt, whether minor wealth to be included on included in schedule AL of parents. Yes, clubbing provision. First, let me come to first question, whether mediclaim. See, if it is a needs to be identified, mediclaim is paid for what purpose? If it is for as I said, maybe personal accident policy or mediclaim policy, then it is to be, it is not taxed as a perquisite. Whether minors' wealth to be included in schedule AL of parents, yes, if income is getting clubbed, the schedule AL will also include wealth of the minors. However, if specific head of income, specific income is taxed in the hands of the minor, you need not include it under the schedule AL of parents, and it only gets triggered when the total income of a taxpayer exceeds rupees 50 lakhs. Paid essay tax on 14th of July 2023, but challan is still not reflecting in AIS TIS. Whether we should file return or wait, you can proceed to file return of income, because the essay tax which you pay on 14th of July 2023 will get reflected in current financial year's AIS. In the AIS of 22 financial year 2022-23, it reflects essay tax which you might have paid for financial year 21-22. So once you have paid the essay tax, you can proceed with the filing of return. Is it required to show foreign income while filing income tax return? Yes, you are required. If you are a resident individual, your global income gets taxed. Of course, DTAA benefits are open to you to avail the benefit. Certain compliances which you needs to be done, like filing of form 67, etc., before filing return of income to avail DTAA benefit. Can HRA exemption and home loan deductions be claimed at the same time? No. If you claim HRA exemptions and home deductions, I think you might be speaking about section 80GG. Both the deductions cannot be claimed at the same point of time. Either you can claim HRA or deduction under 80GG. If assessee managing HRA of more than 1 lakh by showing rent to father, apart from rent agreement, is it mandatory to impact bank transfers to father or merely showing? No, you have to pay rent. See, as I said clearly, that payment should be made. If you are claiming HRA, payment of rent should be there. And don't forget that the same has to be offered for tax in the recipient's hand. So if you are paying rent to your father, bank transaction has to happen. Or merely showing it as income from house property in ITR of father. No, I would advise it that you need to pay, and mind well the property is in the name of father. If it is if the property is in your name, this transaction would not work out for claim of HRA exemption. Is it required to show foreign income while filing ITR? Where to report it? TDS has applied on the said foreign income in that country. Yeah, so you need to determine what nature of income you have derived from foreign and the tax aspect which needs to be ascertained based on the documents being filed in foreign country. It might happen that they might be having calendar year as their reporting period. So first identify the nature of income, what is being regarded as foreign income, and then come to tax aspect. You can avail DTAA. One thing is for sure that the same transaction cannot be taxed twice. With respect to disclosure, you need to show foreign income. And whenever there is a foreign income, make sure if there is any foreign assets being held, you disclose foreign assets in Schedule FA. But retention bonus recovery becomes negative amount. I think this is something being missed in this particular query. A client and his wife are a co-owner of a house, but the interest deduction, interest on loan, is wholly claimed by wife. I would appreciate your view. Yes. Of course, certainly, as I said in the recent development where I have highlighted the screenshot of the article being published on Economic Times, where the authorities has specifically prescribed that interest deduction claimed under section 24B has to be proportionate of the taxpayer. So if it is co-ownership of the house, it is better to pay. Of course, you can pay it from one account, but it is better that transfers from one spouse is done to another account. So as per your query, a client and his wife are a co-owner. Wife is paying the interest. Husband has to transfer certain amount to wife's account to avail the benefit of interest. Can LTA exemption for 2 journeys be claimed in the same year? For example, I perform 2 journeys in the same financial year and claim LTA. No, I don't think you can claim 2 journeys under the same financial year. An assessee has to file ITR 2 instead of ITR 1 if the income exceeds 50 lakhs. Is this threshold applicable for gross total income or net taxable income? It is net taxable income after deductions. If it is 50 lakhs, you need to file ITR 2 because of Schedule A. An employee works in 2 different geographies during a period of 5 years, wherein the ESOPs gets vested for services rendered. At the end of 5 years, Associate Bank of India, when he exercises the ESOP, company deducts the tax based on the service period and shows as a perquisite and pays tax accordingly in both geographicals. How the disclosure is to be done in ITR, I think he must be in ITR in India. So first you determine the residential status of the employee, then whether the ESOPs are given by the Indian entity which is listed or of a foreign asset, foreign company. If it is a foreign company, then it is regarded as a capital asset because of course it is not recognized, it is not listed on a recognized stock exchange in India. And if the ESOPs are of Indian entity, then the taxation aspect gets triggered at 2 stages, as I discussed earlier, one at the exercising option and other at the selling option. Company deducts tax based on the ESOP. So once the company is, if it is of a Indian entity being listed, they are deducting tax as a perquisite. So it will be regarded as a perquisite. If I have taken a housing loan from mid of the year, then I take month-wise claim of HRA and show as a interest is shown as a loss from house property. I mean partial months. Didn't understood the specific query.
So Chintan, even the immediate next question is like that. Can I claim both, HRA and if the locations are different, like, let's say somebody has a house in Mumbai and working in Pune and trying to claim HRA as well as inter-deductions. So there are, 1 or 2 such case laws which are favorable to the SSE wherein, SSC demonstrated like, he got a job in Bangalore and he went and stayed over there. Within Bangalore also, there are 1 or 2 tribunal decision where what had happened, the SSC demonstrated that it is taking 2 hours, 3 hours daily, and it is
Yes.
not practically feasible for me to stay in the house where I have purchased the house. So in
Correct.
such exceptional cases, when the cases have traveled up till tribunal, they have been allowed the both basically.
Yeah, so basically it is matter of litigation, because for once you own a particular house, HRA gets seized. So that aspect needs to be demonstrated, as you said, that it takes time. And of course, one of the aspect also that 2 self-occupied properties are allowed to be held. So it is a subject matter of litigation whether it is allowed or not. Place of employment is B. Can HRA and home loan deduction both be claimed? So as long as deduction aspect is coming into picture, both are subject to individuality conditions. So in case of housing loan, of course, you get a housing loan, it means you own a house. And say from the perspective that particular house is under construction, and during those period you stay on a rent. So both the aspects can be taken care of, that HRA is claimed and interest deduction is also claimed. We usually show that particular interest income being paid initially as a pre-construction interest in return of income, which will fetch you deductions in the subsequent year when the property is owned, when the possession has been handed over to the assessee. Until that time, you can claim HRA. Car is provided by a company. Petrol expenses and driver's salary are paid by the employee. Can exemption be given to employee under section 1014(1) of petrol expenses, maintenance expenses, driver salary? See, if this aspect is purely on the documentary, because you need to demonstrate and also inform the employer about the same. Whether tax to be deducted in case of notice period recovery. Okay, these both are different questions. Yes, tax has to be deducted in case of notice period. Notice period usually employer-employee relationship does not get distinguished in case of notice pay period, because during your notice pay period also the employer and employee relationship exists. So tax has to be deducted in case of notice pay period. What should be the value of immovable property in AL? Can we mention the cost? Yes, of course, you have to mention the cost of the immovable property. It is not that you have to mention the market value of the property. Continuation to query on retention bonus. It is paid in previous year and tax paid in previous year. Now in current year, the amount is recovered by the employer for early leaving in current year, which means negative retention bonus in current year. How to show it in ITR? Continuation. This is a specific query. I think the aspect which the employer might have also taken into account in Form 16, because salary gets taxed on accrual due basis. So need to check what appears in Form 16 also, and how this retention bonus is taken care in Form 16.
Correct. So employer has he netted in the current salary or not? That is the question.
Correct.
Based on that, we can understand if he has not, why he has not done that. That is the question which employee should have asked. कि भाई आप मेरा पगार काट तो रहे हो जो पहले आपने declare किया था. Now you are cutting it. So disclose that also.
Disclose that. So you should make sure that your disclosure does not get deviated from Form 16 also. Yes, I think this is the query and question and answer session also. Yeah, I think Ketan bhai, these were the queries, and if there are more queries, we can take up accordingly. These were the questions being mentioned in the chat box. If I have missed any, please let me know. Can take up those queries also.
Oh, no, perfect. You have covered everything. Whatever questions were asked, still we, are on. If someone has any question, we can, take that up. No problem.
One query has just come up. How safe is political party donation? Seems that this is with relation to certain donations being made in few months back. So it is not like it is unsafe as long as legitimacy of the donation is being proved. So you pay it legitimately and then claim a deduction based on the facts and the documents held by you.
So, here one should note that those issues of Gujarat political party coming up and declaring that we have not taken any donation and actually we have returned the cash. So
Claiming
such
certain-
cases obviously will have big implication, 300% penalty and all those things, and people are really screwed with that. So
Correct.
we must keep all this aspect in mind, that tomorrow that political party denies that you have not given me donation and I have given you cash in return of the donation which you have given, then you are screwed up.
That is why I said that salaried taxpayers has very limited tax avenues benefits to claim. So as Ketan bhai rightly said that it depends that how and the intention. So better to make donation to a good political party rather than getting involved in the such type of arrangement. If taxable amount goes above 50 lakhs, till what amount managerial relief? So it so this is very subjective, that if it says if it is 50 lakh 50,000, so marginal relief needs to be calculated according to that, because once you cross the threshold of 50 lakhs, surcharge portion gets triggered. So it depends on the level of income that gets exceeded 50 lakhs. Sir, will be the recording of today's presentation will be available? I think I'm not aware, might be available for future reference also.
Yeah, it will be made available. It is always subject to the speaker's approval and ICI approval. So
Correct.
since this question has come, I'll take approval of speaker, and of course,
Yes.
in due course, we'll take the approval of ICA and then host the entire recording.
Of course, sir, if it benefits the taxpayers at large and the professionals, and of course, we are free to circulate it. We pay bonus at the time of Diwali. Suppose an employee leaves in financial year 23-24, we will pay him bonus in 24-25. Whether we need to issue form 16. Yes, so this aspect needs to be addressed. That it happens that a particular employee is not having taxable income. That is, he might be below 5 lakhs of income. Better to show the transaction in form 16, so that you can in form 24Q statement of return and issue him a form 16. So this aspect where Diwali bonus of 23-24 is paid in 24-25, you have to issue form 16 to that particular employee.
So
However,
Chintan,
you'll
bonus
be-
is for which Diwali? It is going to come in 24, for
That
that
is
you are
why
providing in
I
March
didn't
23.
question. I didn't question that because no one would prefer getting Diwali bonus 1 year after. So
And
he
if
will
it is
not be
March 24
celebrating.
Diwali, you cannot do the provisioning in March 23.
He might be probably enjoying the fruits of previous year's Diwali.
Then 6 months have passed to that Diwali and still you are not paid.
So this I've not come across such a transaction where Diwali bonus is shifted by 1 year. So, and of course, it is not a good practice uh, giving postponing the bonus. It usually hampers the the mindset of the employees. For small contribution to NGO, from where can we get information that whether it is 50%? So yeah, so the income tax has prescribed certain assessees wherein you can get 100% exemption under ATG. If it is, if the NGO is apart from those 100%, you will be available, you will be eligible for 50% exemption only. However, you also need to take into account the adjusted total income aspect also, because if he should fall within that particular bracket. If adjusted total income is less, you will get that proportionate deduction and not exactly 50% of the donation being made. We are not paying in F and F. I think he must be mentioning full and final settlement. Full and
In
final
that 10,
settlement.
10B also you can mention the donation. That is also
Yeah,
must now.
yeah. If you make donation, make sure that you obtain certificate in 10B. I'll just highlight that particular aspect from this financial year. The trust to which you make donation is liable to file Form 10BD. 10BD covers the details of the amount being received by the trust and from whom it has been received. So they need to mention the details of the donors, and based on their filing, certificate in Form 10BE gets generated from the income tax website, and then it is provided to the donors. You need to mention the acknowledgement number of 10BE wherever you claim ATG deduction. So make sure that you hold on record Form 10BE, which is to be obtained from the trust. In case of NRI, dividend on Indian shares taxed at special rate of 20%. Will any basic exemption limit be available on this? Assessee's taxable income is below, I think for non-resident, basic exemption limit is not available. So this dividend gets taxed at a special rate of 20%. We might be speaking about the basic exemption of 2.5 lakhs and the differential from differential amount. If it exceeds the capital gain amount, respective it is not taxed. The differential amount is not taxed. So that is not available in case of NRI. It is available on this particular basic exemption limit benefit is available only to resident individuals. I would like to add that you need to file return of income also if you want to claim a tax benefit of the 20% being deducted by the Indian entity. Is NPS deduction available under the NI regime or of both the employers contribution and ATCCD? So this is a deduction aspect under chapter 6A. As I said that under the new tax regime, there are no exemptions and deductions being available for individual whoever opts for it. Mind well, I'll just add over here the new tax regime which has been prescribed by this Finance Act 2023. They are yet to prescribe certain forms and rules, because as compared to earlier Finance Act 2020, wherein they prescribed filing of Form 10 IC or 10 IE if a new tax regime is opted. So for this current new tax regime. So new tax regime basically gets divided into two parts, one in financial year 2020 and one in 2023. Because what if there is a new tax?
Chintan, for business return only we have to file that form, no? Currently.
Yeah. Currently, if there is a business income, form 10 by I is to be filed.
And even in new regime, one more change which is coming up is that standard deduction of that 50,000
Is available.
in the next financial year.
Yes, from next financial year. I've covered in my this.
Maybe I missed that.
Yeah, I've covered. And even if you have business income, if you have opted a new regime for the subsequent years, you are by default covered under the new regime. You have to opt out only once, and again you cannot opt for the new tax regime till the time you have business income. If you cease to have business income, you can switch for regime in each year. However, there is a practical issue being faced, and we are just looking into that aspect also. I'll just share that a particular assessee was having business income and he has filed a Form 10 IE in the previous year. However, in this particular year, he is not having business income and he wants to opt for old regime. So opting out in that Form 10 IE, by default, it is selecting an option that you have opted out of a new regime. So in next financial year, if he wants to opt for a new regime, you have to see how the practicality of the portal reacts, whether he can opt or not. In this NPS deduction also, I'll add employees contribution also is obviously available as a deduction. However, employers contribution is also available as a deduction under 80 CCD. So certain you can structure your salary framework in a way that you get the benefit of employers NPS contribution also, which is in addition to 50,000 contribution being made by the taxpayer. So if employer contributes in NPS on your behalf, then you get deduction of that aspect also.
Nothing good. I think Chintan, we had, a wonderful discussion. I think I see one more Aarti Mehta has posted something.
Yeah,
Please speak.
so is it over and above ATC limit? Yes, it is in addition to ATC limit of 1.5 lakhs. So NPS is an additional deductions which you can claim in your return of income. No, I mean the employer contribution is made over and above. Yes, it is the employer's contribution in NPS is more over and above ATC. So if employer contributes to NPS, you can claim as an additional deduction in return of income.
Yeah. So that is over and above that 2 lakh also. Like 50,000 we have
2 lakhs
increased
also.
our contribution,
Yes.
and then
Yes,
another
yes.
1,50,000 you can claim.
Correct. I'll also like to highlight that one aspect also, that presumptive taxation, if a particular taxpayer opts for a presumptive taxation, say maybe a proprietor, then it does not debar him from claiming or opting for a new regime. There is a misconception from anybody that if presumptive taxation is opted, then new taxation regime is not available to him. That is not correct. Even if presumptive taxation is opted by a taxpayer, he can still opt for a new tax regime because both these sections are different. And new tax regime does not deny the fact that if presumptive taxation is being opted, you cannot opt for new tax regime. You can very well opt for a new tax regime.
I think we've covered all the questions which have come up, and Chintan was kind to share his number also. So if anytime we have any such more practical difficulties, we can try and reach out to him probably as and when he is free in the evening or something like that. Maybe he will respond over the WhatsApp. Once again, on behalf of the entire council, Western India Regional Council, let me thank Chintan for a lovely presentation. I think he went step by step very coolly, and in a month of July, under so much pressure, he is able to keep cool himself. That's the positiveness. I think Dolly is saying that please display the number again. Chintan, if you don't mind, please share your number over the just now only if you can, or maybe on the chat so people can note it.
Share my number over the chat box.
Yeah, very good. So, friends, as you know, this 4 days we are going to discuss each head and practical issues in the ITR filing. So please join tomorrow, and following all 3 days. We have tomorrow again an eminent speaker who is into taxation, into one of the big four, Vyomesh Pathak. He'll be taking up capital gain, and then following days we have business and other sources also. So all 4 days we will discuss the basic provisions, and then we will take up the ITR part, and then the question answers like today. And all these 4 days you will be able to solve your practical questions and doubts relating to the ITR. Once again, thanking Chintan for his valuable time and support to the WIRC ICI. In fact, all these 4 days speakers have agreed at very, very short notice, just in last 3-4 days. Dolly is saying number is not visible in chat box. Chintan, maybe for her benefit, you can just repeat once the number.
I'll repeat the number.
9820751229.
Correct.
I think Dolly, it's visible. Maybe there may be some technical issue at your end. Okay. Got it.
Yeah.
Chintan, it is you will have to put it for everyone. That was the main issue.
Yeah.
I think you are putting it for faculty.
I'll
Instead
just
of that,
put it. Yeah. I'll
reply.
put the general.
No, that's okay, Dolly. That's okay. Just say reply all. Chintan, you are putting up now. You are putting up for only if
Only a specific query.
host only. So that's why she's not able to see. So I have posted, Chintan, I just now posted. Now
Okay.
it is for everyone. So
Yeah,
I hope everyone is able to see the
Correct.
number. So once again, really thankful to Chintan for sparing his valuable time and, sharing this presentation. With your, consent, Chintan, we will upload this presentation first, and post the permission, we will try and upload this, the entire session also online, live on the WRC site. So once again, thanking each and every participant for joining this seminar, this webinar of 4 days session on Relearn Income Tax Series. And also, making it very interactive by sharing your doubts into chat box. Really thankful to each and everyone. Thank you so much.
Thank you, Ketan. It was pleasure being over here on the WRC platform. And just a request to all the participants: if I have missed or I have missed certain points in your queries, you are free to reach it out to me. My contact details have already shared, and it is also mentioned on the presentation. Thank you, everyone. Thank you for patient hearing.
Thank you everyone.